Notes receivable are very similar to accounts receivable, but are more formal credit arrangements evidenced by a written note or debt instrument. Notes receivable typically arise from loans to other entities, loans to stockholders and employees, and sometimes the sale of merchandise, other assets, or services. We're going to talk about notes and interest receivable in this section. So like accounts receivable, notes receivable are assets, and therefore they have a normal debit balance. We classify notes receivable as either current or non-current, depending on when the collection date is. If the time to maturity is longer than 1 year, then that note is a long-term asset. Let's take a moment to look at various components in the notes receivable. Here is the face value. Here is the due date, the payee, the interest rate, the maker, and the date is up there up at the top. When Justin is not able to pay for the services immediately and offers a 6-month 12% promissory note, Kimzey records the note as shown here. Note that Kimzey expects to receive the $10,000 note plus interest of 12% in 6 months. However, Kimzey doesn't record any interest on the day the note's issued because none of the interest has been earned as of yet. It's important to note note receivables are similar to accounts receivable, except the biggest difference is notes receivable are a bit more formal with a written instrument. We calculate interest as the face value of the note multiplied by the stated annual interest rate multiplied by the appropriate fraction of the year that the note is outstanding. Interest rates are normally given based on an annual period, so if the interest period involves less than 1 year, we have to multiply by the fraction of the year to get the correct amount of interest. We record the collection of notes receivable the same way as collection of accounts receivable, except that we also record interest earned as interest revenue in the income statement. Over the 6-month period, Kimzey earns interest revenue of $600. The credit to notes receivable reduces the balance in that account to 0, which is the amount Justin owes after payment happens to Kimzey. It frequently happens that a note is issued in 1 year and the maturity date occurs in the following year. So for example, what if Justin Payne issued the previous 6-month note to Kimzey on November 1st instead of February 1st? In that case, the $10,000 face value principal and the $600 interest on the 6-month note aren't due until May 1st of the next year. The length of the note for 6 months and the interest rate of 12% still remain the same, and so the interest of $600 charged to Justin remains the same, but Kimzey will earn interest revenue in 2 separate accounting periods, assuming Kimzey uses a calendar year. For 2 months of the 6-month note in 2018, November and December, and 4 months in the next year, January through April. Because Kimzey earns 2 months of interest in 2018, it must accrue that interest as revenue on December 31st, 2018, even though no cash has been collected. The first entry shown in this slide is to record the adjustment to accrue interest revenue. And then on May 1st, 2019, the maturity date, Kimzey records the collection of the note receivable of $10,000 and interest of $600. Notice that the cash collected for interest includes a $200 receivable from 2018 as well as a $400 of additional interest revenue related to the 4 months in 2019. After the entry on May 1st, the balance of notes receivable and interest receivable are now zero because the customer no longer owes any of these amounts. Let's do another multiple choice here. A company accepts a note receivable of $5,000 on September 1st, 2018 that matures in 10 months and has stated interest of 6%. What amount of interest revenue will the company record in 2018 and 2019? So if you think about that, 10 months of interest, 6%. This was taken out in September. So in 2018, there are 4 months of interest. And in 2019, there are 6 months of interest. So you see, 5,000, 6% times 4/12 gives you the $100 in 2018 and then $150 for 2019. Now we are going to look at understanding ratios. And we're going to look at a couple key ratios. The receivables turnover ratio shows the number of times during a year that the average accounts receivable balance is collected or turns over. The net in net credit sales refers to total credit sales net of discounts, returns, and allowances. The amount for net credit sales is obtained from the current period's income statement. Average accounts receivable equals the average of accounts receivable reported in this period's and last period's balance sheets. The more frequently a business is able to turn over its average accounts receivable, the more quickly it's receiving cash from its customers, which is a good thing. The average collection period shows the approximate number of days the average accounts receivable balance is outstanding. The more quickly a company can collect receivables, the more quickly it can use that cash to generate more cash by reinvesting in the business and in added sales. Here are the two ratios for Tenet Healthcare and LifePoint hospitals. We see that Tenet has a higher receivables turnover and a shorter collection period, showing that this company more efficiently collects cash from patients than does LifePoint. Again, another key point here. The receivables turnover ratio and average collection period can provide an indication of management's ability to collect cash from customers in a timely manner. Okay. Which of the following would be true for a company that has an accounts receivable turnover of 10? Is it that A, the company turns over their accounts receivable more than once a month? Or the company would have an average collection period of 336.5 days? C, the company would be considered as doing an efficient job of collecting receivables if the terms were net 30? Or D, the company would have an average collection period of 20 days. Remember how many days are in a year with a receivable turnover of 10 means the company would have an average collection period of 36.5 days. You would just take the number of days in a year, divide that by 10 to give us our collection period. Now let's look at estimating the uncollectible accounts using the percent of credit sales method. So previously we estimated uncollectible accounts based on a percent of account receivables at the end of the period. As an alternative, we can estimate uncollectible accounts based on the percentage of credit sales for the year, aptly referred to as percentage of credit sales method, or the income statement method, because we base the estimate of bad debts on an income statement amount, credit sales. When applying the percentage of credit sales method, we adjust the allowance for uncollectible accounts for the current year's credit sales that we don't expect to collect, rather than adjusting at the end of the year for the percentage of accounts receivable we don't expect to collect. So let's compare the percentage of the percentage of credit sales method to the percentage of receivables method. As in the previous slides, assume Kimzey had 2019 ending balance of accounts receivable is 30 million. Kimzey estimates that 8 of these receivables, 8 million of them, will not be collected next year. This estimate comes from the percentage of receivables approach, which bases the estimate of bad debts off a percentage of receivables, often using an aging approach. In contrast, this percentage of credit sales approach basis the estimate of bad debts off a percentage of credit sales in the current year. In this case, Kimzey estimates that 12.5% of credit sales in 2019 will not be collected in 2020, which means the estimate of bad debts is 10 million, which is 80 million times 12.5%. Note that this estimate differs from the one under the percentage of receivables approach, which will generally be the case. So this slide is going to demonstrate the differences in the two methods when adjusting for estimates of uncollectibles accounts. Notice that the two methods for estimating uncollectible accounts results in different adjustments. Because the amounts of the adjustments differ, the effects on the financial statements differ. Remember that the balance of the allowance account before adjustment is a 1 million credit. After adjustment, the balance of the allowance account will differ between the two methods, as will the amount of bad debt expense. Under the percentage of receivables method, we adjust the allowance account so that its ending balance equals the estimate of bad debts. By contrast, under the percentage of credit sales method, we record the adjustment for the estimate of bad debts, so this amount adds to the current balance of the allowance account. This slide summarizes the difference in financial statement effects. From an income statement perspective, some argue that the percentage of credit sales method provides a better method for estimating bad debts because the expense bad debts are better matched with revenues, credit sales. A better matching of expenses and revenues result in a more accurate measure of net income for the period. From a balance sheet perspective, though, the percentage of revenues method is preferable because assets, the net accounts receivable, are reported closer to their net realizable value. The current emphasis on better measurement of assets, which is that balance sheet focus, outweighs the emphasis on better measurement of net income, which would be the income statement focus. This is why the percentage of revenues method, which is the balance sheet method, is the preferable method, while the percentage of credit sales method, again, the income statement method, is allowed only if amounts do not differ significantly from estimates using the percentage of receivables method. Let's look at another multiple choice here. On December 31st, before adjusting entries, a company reports the following balances. So we've got accounts receivable of $100,000, allowance for uncollectibles of $2,000 credit, and credit sales of $500,000. The company estimates bad debt to be 4% of credit sales. The adjusting entry would include A debit to bad debt expense of $18,000, B, a credit to allowance for uncollectible accounts for $24,000, C, a credit to allowance for uncollectible accounts for $22,000, D, a debit to bad debt expense for $20,000. So bad debts to be 4% of credit sales, a debit to bad debt expense of $20,000. The credit sales of $500,000 at 4% is the $20,000. We're going to finish with exercise 521. On January 1st of 2018, the general ledger of 3D Family Fireworks includes the following account balances. So we've got cash of a debit $23,900, accounts receivable $13,600. The allowance for uncollectible accounts is a credit $1,400. Supplies $2,500. Notes receivable, a 6% due in 2 years, $20,000. Land $77,000. Accounts payable, a credit $7,200. Common stock $96,000. Retained earnings $32,400. It gives us several transactions, and the first thing we're going to do is record each of these transactions. Provide services to customers for cash of $35,100. Provide services to customers on account, $72,400. Write off accounts receivable as uncollectible, $1,000. Pay cash for salaries, $31,400. Receive cash on accounts receivable, $70,000. Pay cash on accounts payable, $5,500. And pay cash for utilities in January, $13,700. So let's do that first. So as you see, if you go back to this slide, each of these transactions are being reported here, showing the cash for revenues, showing the revenues on account is the January 6th, showing the account uncollectible, how we debited our allowance and we credited our accounts receivable, paying salaries, collecting cash on accounts, paying cash on accounts, and then paying our utility bill. The next thing it asks us to do is to record the adjusting entries on January 31st. So as you see here, it tells us at the end of January, $5,000 of accounts receivable are past due, and the company estimates that 20% of these accounts will not be collected. Of the remaining accounts receivable, the company estimates that 5% will not be collected. The notes receivable of $20,000 is considered fully collectible and therefore is not included in the estimate of uncollectible accounts. So let's create this adjusting journal entry first. As you see here, we take a bad debt expense and we credit our allowance for uncollectibles. Now we're doing that based on the $5,000 accounts receivable are past due. And the first journal entry involves gathering a lot of the information that was given to us in the problem. So the adjustment for the uncollectible account would be a debit to bad debt expense for $1,100, a credit to the allowance for uncollectible accounts. Now you see here how we are gathering this information. It's basically the information about the $5,000, they estimate 20%, and then the remaining is estimated at 5% won't be collected. Now to get that remaining, the $10,000 at 5%, you have to take the initial accounts receivable balance plus the sales minus the cash they collected on sales minus what was written off minus the amount that is expected to be collected to come up with that amount, and then the $400 remaining is, as you can see in the front, the 14 minus the 1,000. So take some time to look at how we have adjusted for this bad debt expense. B, supplies at the end of January total $700. Well, if the supplies total $700, we have to show how much has been used, which we started at $2,500. If at the end of the month there's $700, that means we've used up $1,800. So our supplies expense would be a debit of $1,800. We would credit our asset supplies for $1,800. Then C, accrued interest revenue on notes receivable for January. Interest is expected to be received each December 31st. Again, what we do is we take our $20,000 note at a 6% interest rate for 1 month, gives us the $100 interest receivable. Our credit is a revenue account, interest revenue. And then the last one is just to record unpaid salaries. Salaries expense, $33,500. We'll credit our salaries payable of $33,500. Then next it asks us to prepare an adjusted trial balance. So basically we are taking all the figures that we've accounted for plus our adjustments to come up with our new trial balance. Again, you notice the debits are going to equal the credits. Then it asks us how we came up with our various figures. So this allows us to see the adjustments of what was added. So the items in red provide you with the adjustments of what's been added to come up with our new figures, our new balances. So the beginning balances you see here are in bold, and then the entries in January are blue, and our adjusting entries are in red to then come up with our ending balances. Then it asks us to prepare an income statement. Now again, if you look back on your adjusted trial balance, the income statement is going to be the bottom portion of revenues and expenses. So we gather that information from the adjusted trial balance. That gives us a net income of $26,100. Our classified balance sheet, again, will also come from that adjusted trial balance. The net income of $26,100 here will end up becoming part of our stockholders' equity in the retained earnings section. So you see what we started with, our $32,400 plus our $26,100 net income. There were not any dividends paid out, gives us our ending retained earnings balance here of $58,500. Everything else comes directly from the adjusted trial balance. Our closing entries basically close out any temporary accounts, income statement accounts, and if we did have dividends. So the service revenue and interest revenue are being debited to zero those accounts, and we credit it to retained earnings. That closes out our revenue accounts. Then our expense accounts get credited to zero them out, and we debit retained earnings in order to close out those expense accounts. Then it asks us about what the receivable turnover ratio is. So we would basically take our net credit sales, divide that by our average accounts receivable. Our average accounts receivable would be the beginning balance plus the ending balance, divide that by 2. And you take the credit sales, divide that by the average accounts receivable to come up with the turnover ratio. A ratio of 5.1 suggests that credit sales are about 5 times the average balance of accounts receivable. Companies allow customers to purchase goods and services on account to boost revenues, but these credit sales also create a risk of the customer not paying. So a higher receivables turnover ratio is what you want. Compared to the industry average of 4.2, then this company is collecting cash more efficiently than the industry. So it's better than the industry average, but it still is taking a longer period of time for the monies to be collected. The ratio at the end of January, the allowance for uncollectibles, divide that by the accounts receivable. So the allowance for uncollectible, $1,500, divided by the accounts receivable of $15,000 is 10%. In comparison, the ratio at the beginning of January was 10.3%. So the allowance is lower in relation to accounts receivable at the end of the month, indicating the company expects an improvement in cash collections from customers on credit sales. There you have it for Chapter 5. Please take plenty of time to review this and go through all the other additional exercises I've provided.